This is how you accumulate versus lows, where the stock has pushed up off the low of a base. It's formed 1, 2, 3, 4, or 5 days of tightness, and it keeps respecting a key level. This could be right above a moving average as well. There's often confluence there, but the key thing is that this range keeps respecting a key level in the market, and that is the bottom of the range, and you can enter as it keeps confirming up off that level. You can combine different ways to trade a range to build out your position. You've recognized that the range is pretty mature. It looks ready to break out. It does one last pullback, then pushes higher towards that base. You can anticipate that breakout and enter, setting your stop at the higher low. The third one is a little bit different. We've been forming a range here, and then we get a shakeout below the clear low that we've been accumulating against. Maybe you're stopped out, but this shakeout provides an opportunity, if we quickly reclaim this range low, to enter while managing your stop at this key low here as we reclaim. The last way is just the standard range breakout. We've been forming a range for a few days. You've got a clear buy point. Maybe this is the high of a day, high of the previous day. Maybe this is an inside day right here. We break out through that high, enter right there, manage risk at the low of the day or the low of the prior day, the low of the range. And then you can even add if it does another higher low. I wanted to go through kind of 4 different frameworks that you can use to trade those ranges / tight areas. So something like this, something like here, something like here, where you've got a clear range for at least 2, 3, ideally 4 or 5 days, just like this. So think about when I show this, think about placing that range up the right-hand side of a base. So this is what we're talking about when we're talking about trading a range. So let's get into it. First, and we'll go through in detail each of these, you can accumulate versus lows, where you're kind of buying versus the low of that range. And again, this could be like a daily chart where it shows this happens over the course of many days, where each time it's pulling into the same overall level, gets supported, it's being accumulated. You can buy versus that low, set your stop loss right under those lows. So, if it violates that, over time on a closing basis, you're out with a small loss, but you've got a great cost basis if it does break out of that range. Next, we've got buying tightness, anticipation, as it looks to be breaking out of that range and sets up a higher low. Then you could enter, setting your stop right under that higher low or even the low of that range. That would be a great way to, again, get a really good cost basis with a very tight stop. The third way is kind of my favorite, an undercut and rally, where there's a mature range of a few days. Then we get maybe a gap down in the market or just a big shakeout below the low of that range, and we rally back through that level. It's kind of like that key level reclaim, but on a much smaller time frame. And you can enter versus as we reclaim that level, and even add on as we actually break out through that range. Then lastly, we've got the standard range breakout. This is probably what you guys are most familiar with, where just we break out through key highs and we enter here, setting our stop at the higher low or the low of the range. And you can even add at the next, slight higher low and re-breakout, confirming the breakout of the range. So those are at very high level are the 4 ways to trade a range. So again, this is how you accumulate versus lows, where the stock has pushed up off the low of a base. It's formed 1, 2, 3, 4, or 5 days of tightness, and it keeps respecting a key level. And this could be, a whole number ride. I know you want to talk about that a little bit. This could be right above a moving average as well. There's often confluence there. But the key thing is that this range keeps respecting a key level in the market, and that is the bottom of the range. And you can enter as it keeps confirming up off that level, setting your stop and buying as close to that level as possible. So if you're right, no harm done. You're down very, very minimal amount. And if you're right and we break out from that range, you've got a really good cost basis, managing risk versus that level right here, and you're off to the races if we keep moving higher. Ryan, do you want to talk about kind of how you buy? Because I know you like to buy this way versus a level quite a bit.
Yeah, I pick a level. I mean, the way I look at the markets is if I'm looking at Reddit, for example, which was a trade last year, or A-Lab, I pick, if it's a clear level on the charts, let's say 60 on Reddit, right? Or when it's coming in, it's respecting, the 55 area quite a bit. So that makes it easy for me to track. If we say this is, 55 and this is 60, and the stock on the down days in the market is continuously, holding this 55 level, it allows me to accumulate that stock, within that 1 to 3% range. If it's away from that 55, I can continue to, buy it here rallies, comes back in, buy it again, right? But if it violates that level in the, that 55 level, then I'll be out while keeping my risk in that 1 to 3% range. Now, why would I buy a stock that is pulling back and not breaking out? That's a common question. So as a base builds out, what happens is if a, let's say the market itself is pulling in quite a bit, but the stock continues to respect the level, which let's say is 55 in this case, that's relative strength versus a particular level that I'm interested in. And as long as I can operate within that 1 to 3% or 3 to 4% stop loss range or risk, then I can, continue to accumulate the stock. And what I call that is relative strength versus a level.
Hmm.
What happens is the relative strength line will continue to rise to the upside while the stock continues to respect that 55 hypothetical level that we're speaking of, and the market's pulling back in. So the RS line is rising. The stock wants to outperform the markets. There is market pressure that continues to, push it back right into that level, and it continues to respect and hold that level and not break it. When all those elements combined, take place, what happens is, you can define your risk really, really well. Eventually, what happens is that top side pivot, which is let's say at 60, becomes your secondary or your third or your final buy
Hmm.
point, right? And when the market pressure lifts and the market's fine, the relative strength line will also go up. And what you would ideally want the stock to do is also rip to the upside while breaking your secondary or your tertiary entry area on the top side. So I hope that makes sense. I love doing this when you track bases and your bigger bases on the daily charts or the weekly charts, it's the same thing. You'll see the structure of a base will always tend to respect some sort of whole number in the markets, be it 30, 40, 50. And that could be a really easy way for, Nvidia is holding 100 or Google is holding that. Or CELH, when it was in that uptrend, held that 30 area for about 18, it held $17.50 throughout its whole base. That allowed you to, track the stock really easily, but most importantly, define your risk and also your stop loss. That's, I think, the bigger, objective here is if I can get away with a risk of 1 to 3% or 3 to 4% in on any setup, I'm in the driver's seat and I can dictate the action because I can dictate, I know how much I'm going to lose if this were to come back in and fail on me.
Yep. Perfect. The next way is kind of a step up. So here you've been maybe accumulating versus lows, and like Rye said, you can combine different ways to trade a range to build out your position. This might be you've recognized that the range is pretty mature. It looks ready to break out. It does one last pullback, then pushes higher towards that base. You can anticipate that breakout and enter, setting your stop at the higher low. So here you would set your stop with this one. You'd set your stop at the low of the range as you accumulate here. Here you're setting your stop pretty tightly at that higher low, anticipating the breakout. And this could be kind of your second buy after maybe you've been accumulating your lows. Then the third one is a little bit different. We've been forming a range here, and then we get a shakeout below the clear low that we've been accumulating against. Maybe you're stopped out, but this shakeout provides an opportunity if we quickly reclaim this range low to enter while managing your stop at this key low here as we reclaim. And this might happen at an oops reversal, which is something we'll talk about later. But basically, you've got a clearly defined range right here. We get a shakeout lower and then a reclaim of that range low. You enter there, and then you can even enter again at the true range breakout, as we re-break out and reconfirm. But this is kind of my favorite personally, where we've got a range and it stops everybody out. And then that often leads to rapid movement to the upside if we reclaim that range low. And you can set your stop really tightly at that key low where it reversed up from as it reclaimed that level. Lastly, this yeah, go
One of
ahead.
the hardest things, if you just go
Yep.
back, to do is, let's say, you're trading versus this level and you get stopped out right here, right? That's what we spoke about in the previous slide. And the fact that you get stopped out, it becomes infinitely hard to buy it back right here. It's the most uncomfortable thing that you could possibly do because the stock that you were watching voided your thesis and said that, now wasn't the right time. And it's, buying it back right here is one of the hardest things, and it mostly comes with experience. A lot of experience and a lot of seeing the situation, right? Something made the stock really, really special in this range right here, right? And the fact that it undercut and took out a bunch of stops, but then reclaimed it, uh, you know, whatever that was special about it, is likely still special if it reclaims that area once again. It's one of the hardest things to get, around. It's tough, but watch for these situations, right? When you get stopped out of a trade, continue to track it, and if it starts working thereafter, it may just be that you were a little early to whatever, you thought, whatever you thought that made that name super special is still special when it reclaims that level, right? It's just that it took you out, and you get a little bit sour, or you start to, move on to the next stock, or you stop paying attention. And many times, me personally as well, I miss a lot of really good looking stocks where I had the right idea, I had the right, I was looking at the right stock, but what happened was I got stopped out of it, and now I don't want to buy it back, right? So that's something you have to keep in mind is, whatever made it special over here and when you were tracking it, there's nothing that's changed other than that, it stopped you out, and now you have to, figure out a way to buy it back. So,
Yep. And then the last way is just the standard range breakout, which is kind of more what we've been talking about, where we've been forming a range for a few days. You've got a clear buy point. Maybe this is the high of a day, high of the previous day. Maybe this is an inside day right here. We break out through that high, enter right there, manage risk at the low of the day or the low of the prior day, the low of the range. And then you can even add if it does another higher low. This is kind of the more standard way. And I think this one and then this one are my favorite, is the undercut buy here, and then you can even add as it breaks out through the true breakout. But this is just kind of conceptually what we're talking about when we're talking about consolidation pivots and range breakouts. Also, just to kind of lay it out there, this is where these range breakouts can happen. You can do up the right-hand side of the base. You can have a range after the breakout, and you can also do it as it pulls back into a base. So there's many different places ranges can form, but they're constructive as they do. And these concepts right here allow you to trade them while managing risk at clear levels that, like we talked about, the low of the range, the low of the higher low, the low as it breaks lower, as it reconfirms up, and at the higher low of the day before. So that's kind of what I want to talk about here with the range breakout.